Hello, everyone, and welcome to the Black Geek Week series led by Springllc and hosted by Bloomberg. I'm Evan Jean, an engineer here at Bloomberg and co-leader of the Bloomberg Black in Tech community. Thank you so much for joining us today. There is so much going on in the world, and it means a lot to us that you're here and taking time to participate in what is sure to be an engaging conversation with our guest speaker, Michael Seibel, CEO of Y Combinator, in conversation with our very own Jackie Simmons of Bloomberg News on how masters of big ideas thrive in intensively competitive ecosystems. At Bloomberg, we are committed to convening people through thought leadership and dialogue that help bridge gaps and form strong networks within industries where diversity is underrepresented. This is important for us as we continue to be at the forefront of innovation and making an impact with over 5,000 engineers and data scientists globally that builds and advance new solutions. And we are happy to partner on efforts with like-minded organizations like Springllc's Black Geek Week Sessions, whose mission is to bring together industry leaders and a Black and brown population that's hopefully underrepresented, not in numbers, but in recognition. Thank you again for being here. For those of you who may be interested in learning more about Bloomberg, or specifically our efforts in tech, diversity, and inclusion, we'll be in touch via email after the event with relevant contact information. And now I'll turn it over to Michael Aiken, Managing Director from Springllc and the producer of Black Geek Week Sessions. Thank you.
Thank you, Evans. So we're glad to be back. Black Geek Week continues its stunning growth, and we're thrilled to host our first virtual session. We'll resume live events when we are able to do so safely. I want to thank Bloomberg for continuing to partnering with us and committing to do this right. As Evan said, if you're considering a new job, there's a career link in your invitation to what of last night was 195 worldwide Bloomberg engineering jobs. For those new among us, what is Black Geek Week? Well, Black Geek Week is a series of events designed to gather top technologists, engineers, creators, hackers, and thinkers that happen to be of color to celebrate creativity machines, AI, IoT, transportation innovation, alternative energy, health sciences, and other products of Audacity, as well as the ideas, innovation, and entrepreneurship that underpin them. You all already have the ability and drive. We just want to contribute connectivity, camaraderie, and intellectual discussion that will accelerate our community and create relationships that foster an even faster growth curve. With that, I want to acknowledge the exceptional talent in the room. As I always say, there's nothing coming over the horizon that isn't represented right here or within the network we are building. There are literally hundreds of you that could easily be speaking at one of our sessions. We have engineers from NASA and SpaceX, PhDs in virtually any discipline you could think of, Rhodes Scholars, valedictorians at Ivy League schools, HBCUs, and everything in between, institutionally funded entrepreneurs, lifelong learners, continually investing in themselves, et cetera, et cetera. So thank you. We're proud to have you. Now for some quick housekeeping. The next Black Geek Week is scheduled for September, so please be sure to connect with us at BG Week on Twitter for the latest updates. If you have a question this evening, simply type it in the Q&A box to the right of the video window and we'll try to get to it. And a quick note about Seibel's Y Combinator. They have an online program called YC Startup School that is free. Take it. It's the most powerful entrepreneurial platform I've ever experienced. And without further delay, let me introduce Jackie Simmons, Senior Executive Editor Americas for Bloomberg News, and Michael Seibel, CEO of Y Combinator.
Great, thank you so much. It's an honor and a pleasure to be in conversation with Michael Seibel, CEO of Y Combinator. Y Combinator has funded and nurtured 2,500 startups with a combined value of more than $155 billion. Many include names that resonate globally: Airbnb, DoorDash, Instacart, Dropbox, and Reddit, which we'll spend a few minutes on, given it was just announced last week that Michael would join that board. So I'll ask questions for the next 40 minutes or so, and then we'll open it to Q&A. Please contribute. We'll take Q&A from the floor, and we'll end up with a little treat at the very end. But first, I want to start with a bit of a scene set on Michael. Michael, you've gone from Yale, a political science degree in 2005 to kickstarting your own company, and now you're helping thousands of companies get underway, all by the age of 37. How does a poli-sci major migrate towards a career funding companies?
I would say a lot of luck. So, one, growing up, we always had a computer in our home, which was very, very valuable. My dad was a self-taught software engineer, and so just familiarity with computers was just part of my growing up, even though I never became a programmer. Um, I would say I got a lot of luck to become friends with my future co-founder, Justin Kahn, in college, and a lot more luck to have a successful startup that kind of gave me the opportunity to get my job at YC. So a lot of things broke my way, and very grateful for it.
I just wonder if you'd talk just for a second about your first company and what that was like, and what was your biggest sort of lessons that you would impart on anyone sort of trying and wanting to move into that space and found their own company.
So my first company was originally called Justin TV. And then that morphed into a company called Twitch, which sold to Amazon for about $1 billion. And the goal of the company when it launched, excuse me, the goal of the company when it launched was to create an online reality TV show, which I would argue was a very bad idea. It then morphed into creating a platform where anyone could broadcast live video online, which was a better idea. And then finally morphed into Twitch, which is a platform where anyone can broadcast video gaming online. And that was the idea that ended up working. And my biggest takeaway from that experience was I had incredibly good technical co-founders. We had a co-founding team of 4, myself, Justin Kahn, Emmett Shear, and Kyle Vogt. And Emmett, Kyle, and Justin were all engineers. And every time we had to change what we were doing, we had to figure out a new play, we had to figure out a new feature, they and the employees that we hired could build anything we needed. And I think that that was really the superpower that we had.
I want to talk, I want to talk a little bit about, the context of the world we're living in right now. Obviously we're in a recession, some argue a depression. Tech companies of all sizes, shapes, and creeds, we've reported have cut something like 40,000 jobs since the middle of March. Can you talk a little bit about the differences between running your business pre-COVID lockdown versus today?
Yes, I think that there was, in the last 5 years, there were a lot of companies that were funded that weren't strictly technology companies. They had like a thin layer of software, but in reality, they were lower margin, either more service oriented or more consulting oriented, or really not software companies. And we can go into all the reasons why those companies were funded, but like during an era of cheap money, as long as those companies continued to show top line revenue growth, they kept on raising money. And I think that that unfortunately kind of educated a recent group of entrepreneurs to think that like capital intensive businesses were businesses that were easy to fundraise for. I think starting with Uber's performance in the public market, then moving to WeWork, and then moving to the economic crisis caused by COVID, investors are a lot less interested in funding those companies, specifically because those companies tend to need a lot more money in order to become profitable. And so I think kind of the biggest lesson to be learned is if you are trying to copy the exact model of operationally intensive business that worked over the last 5 years and expecting the same amount of funding, that might not happen anymore. And businesses that are more focused on software with software margins look relatively better now because investors understand that those businesses need less money to get to profitability.
Mhm. At the same time, we talked about this before this call, and your company, YC, is accepting, you said, the same number of applications as before mid-March. Where's that? Where are they coming from, and what's driving that?
So our applicant pool is all around the world now. Nowadays, anywhere between 30 and 50% of a batch will be founders who are building businesses not for the U.S. market and who are located not in the U.S. I think that there's just always, the startup world is big enough now that there's always demand to be starting companies. And even though we saw a small drop in applications, we still got, over 12,000 applications for this current batch, of which we accepted about 220 or so companies.
Yeah, I want to come back to that, but you talked about sort of what's changed in the landscape, and there's just not as much money sloshing around for the types of investments you described before. At the same time, I do wonder, as the economy, and if the economy continues to crater, what are the signs in the macro that you're looking out for that could impact your business?
So I will say this: around March, when the public markets looked a lot worse, we definitely saw a lot of early stage funds and angels get a lot more nervous about writing checks. So I think early stage founders have to be careful and keep an eye on the public market. I think that when the public market was doing very poorly in 2008, 2009, there was a very, very clear backlash in investing in the startup world. And I think that basically a lot of angel investing, it's not really directly tied to the public market in terms of it's not like the money is coming from the public market, but it's more the public market is setting the investor's appetite to write checks. And
Right.
if the public market's doing poorly, that appetite goes down and the criteria goes up. So that'd be the biggest indicator that I've.
Fair enough. And so we know that some of the smaller startups, in spite of, the picture you're drawing, are under more pressure. VCs are focusing more on making sure portfolio companies can weather the pandemic and financial climate. I wonder if you could just talk a little bit about how that's affecting fundraising.
Yeah, I think that once again, when the market was looking worse in March, investors both were getting nervous about writing checks and also had to do a lot of work inside of their current portfolio to understand which of their existing investments needed more money. The market's coming back and that work has been done. So, we're seeing YC companies raise money. But once again, as I said, I think a lot of this, the early indicator is the public market.
Got it. The other question, I think, in this pocket of, how's business? And then I want to sort of seg over to some more existential conversations around racial injustice and diversity. But it has to do with, before we go there, I want to talk about valuations really quickly. And startup valuations, we know, are still rising, but they're rising at a much slower pace to the average month of 2019, which isn't a huge surprise given everything. But what's your take on the outlook for valuations?
So I think what causes valuations to go up is the supply of capital, the number of funds, the amount of money they have to invest. And I think that over the last 5 years, the number of early stage funds has exploded and the amount of money they have to invest has exploded. I think right now we're at an interesting time because while there's a lot of money and a lot of funds, all investors kind of understand that in a time of economic uncertainty, they collectively have an excuse for getting better prices. And so, whereas all investors would not be able to collaborate by themselves, this kind of external event has caused them to all agree this is a good reason to have lower prices. So I think that what we've seen is for companies that are doing really well, still competitive. For companies that are doing okay but not great, they need to adjust their valuation expectations. And I kind of assume that's going to be the case for a little while. So when we talk to YC companies, we certainly tell them that they should be changing their expectations compared to this time last year. Maybe they'll get lucky and things will go great, and then this won't be an issue. But like, I'd rather them be prepared for a harder fundraise and be surprised when it goes well.
Sure. And just, because you are getting this, voluminous number of applications coming in, I wondered are you seeing any difference between the kinds of applications that are coming in, say, pre-lockdown versus post-lockdown? Is there any sort of shift or sort of evidence that the mood is different amongst the potential founders out there?
So what I would say is like one common and unfortunate trait amongst a lot of founders is that they think they should be working on companies in spaces that are hot at this exact moment. And so probably the biggest thing we've seen in this interview cycle is remote work, live video, live online events, Zoom competitors, all of that kind of stuff, which is fine. And we've taken some of it. But to be honest, like the companies that are best capitalizing on this moment are the companies that started years ago, right? Like Zoom is a perfect example. They're amazingly capitalized on this moment, but they started years ago when like no one could have foreseen a COVID style event. So in general, I would say that like responding with a startup idea to the news, the mass media of the moment is probably not the best strategy.
Got it. We don't need pile-in. Okay, let me ask you a question, because you said something interesting a couple hours ago. You talked about the difference between diversity discussions that are happening within the tech space versus the ones that are happening in the startup communities. And I wonder if you could just lay that out. What's the difference?
So I think that when you're talking about diversity in big tech, what you're really asking is, do talented, underrepresented employees have access to jobs at large tech companies? Because you're basically assuming that all things being equal, if they had a choice between working in finance and working in tech, some percentage of them would work with tech if they had the opportunity. So when you look at kind of the big companies who are offering safe jobs, you have to kind of ask the question like, why aren't underrepresented people taking those safe jobs? In the startup world, it's very different. The startup world is fundamentally much more risky. And for most people, the risk reward calculation for doing a startup is a very, very hard calculation. And so I think that in the startup world, you can't just ask the question, why aren't underrepresented founders getting more opportunities? You also have to ask the question, for the most talented underrepresented founders, does it make sense for them to do a startup? Why or why not? And certainly socioeconomic factors are the most critical factors in my experience talking to founders in making this decision. So to be more specific, there's a set of extremely talented underrepresented founders who effectively have personally opted out of doing startups because they are the safety net, the primary breadwinner, not only of their immediate family, but often of their extended family. And so the rest of their family is relying on their income. They're either sending money home or helping people pay bills or helping people with emergencies. And so when they think about doing startup, they're not only thinking about the risk they're taking, they're thinking about the risk that their whole family is taking. And that's a different calculation. So oftentimes when I'm talking to founders who are underrepresented, I try to kind of suss out, instead of kind of saying like, why don't you do a startup? Like you have the skills, you should do it. I try to suss out what is the risk reward? What's their life circumstance? And are they doing the risk reward math correctly? Sometimes I find no, like they're doing the risk reward math wrong. And like they really should consider doing a startup because like other members of their family can be part of the safety net. They have other options. Sometimes when they go over their life story, I think to myself, they're doing the risk reward math right. And like this isn't the most strategic thing. And so I really think that like the risk reward is fundamentally different when deciding on whether to take a job at Google versus deciding whether to do a startup.
So when you've had these conversations, at what point do you say you really need to take a leap of faith and just go for it? And how did you kind of make that calculus knowing that people are saying, on the other side, well, my family's livelihood, it's on me. I've got six figures at, TK tech company. So what's the kind of, when do you know that moment?
I think I've stopped trying to tell that moment. I think the lesson I've learned after doing this for 5 years is that founders should opt into this life because it's not a normal life. And I think there are a lot of sacrifices you have to make to do well at this. And I think that this life is too glorified. Like you would assume that a much greater percentage of people were successful considering how much attention this part of the economy gets. And the reality is that most people fail. And by most, I mean like in the 90% fail. And so I think the thing that I've learned is that if I'm twisting your arm to do this, like that is a very, very bad sign. If after I tell you all of the challenges and you tell me all of the challenges that you have, if you're still down, great, I'm here to help you. But if you decide to opt out, I'm not going to blame you or ridicule you at all, because this is a very, very hard decision to make.
Right. So we wrote a story today, actually we've been writing all week, looking at Black-owned businesses. And I think we used Atlanta as a focal point because I think per capita they have quite a few Black-owned businesses compared to the rest of the region. These are restaurants, these are small businesses, these are a different thing that we're talking about in your space. But can you talk a little bit as people start to regroup from economic calamity, and they try and sort of reinvent themselves, which a lot of people are going to have the option to do in this economy. Yeah. What are some of the alternatives to funding businesses that say don't require a lot of capital? Like an online platform or something like that. Where would you kind of steer people's thinking?
So I think the first thing I would do is just simply introduce the idea that there are a lot of companies online that make it easy for you to start a business with very little upfront capital. And this is new. So it's possible that the people you know, your friends, your family, your parents, don't know about this. And even more importantly, I believe that there's a large information gap when you look at underrepresented founders of businesses on knowledge of these platforms. So whereas 10, 20, 30 years ago, it would have been a great idea to start a restaurant or a barber shop or a local real estate agency, the equivalent of those businesses today is running an Airbnb, running a box subscription with Cratejoy, being your own, like what they call basically being able to launch your own restaurant within your home and distribute on a product like DoorDash. We have a company called Chef that does that. Building your own online store like Shopify. And there are many, many, many companies that now enable you to create an online business. And I think this information needs to be widely spread because I think, unfortunately, tech founders get too much attention for the success rate that they have. Whereas like these businesses are not as sexy. They're not as lucrative, but the chances are the success rate is a lot higher. And so, and the capital required to start is often a lot less. So I really think that a lot of these platforms should be going above and beyond to promote themselves in underrepresented entrepreneurial communities, because I think that this is a way to basically leapfrog the businesses of yesteryear that are harder to make today.
Yeah, and I want to ask about your big news of last week, but before I do so, can you just speak briefly to YC's record of funding Black entrepreneurs? I think you said you funded about 192.
Yeah, so we started tracking these stats in 2015, and since 2015, YC has funded a little over 400 female founders, about 190 Black founders, and a little over 240 Latinx founders, which is a track record that I'm both proud of, but I also feel like we have to improve. As a percentage of all the founders we have funded, it's not enough. On the other hand, when I joined YC, when I did YC both times, there was not a community of over 100 Black people that I could join who were YC alumni. And now there are. So now it's time to kind of further build on top of that existing community.
Okay. And how do you change that ratio to get more? I mean, what's the kind of more immediate way to sort of see that uptake, do you think, and change those percentages?
So I think we've been thinking about two things here. I think one thing we've been thinking about is how can we change the calculation on whether underrepresented potential future founders major in CS in college. And this comes from a lot of our personal experience and my personal experience. Many of the Black students I was friends with at school got into school because they were very good at math and science. Yet many of them were directed, oftentimes by general society, parents, etc., to pre-med or to law or to finance. And I think the world has changed. Those are great professions, but tech is also a great profession. And so I think one thing that we're looking at is how do we redirect those folks into CS? And we have both working with a nonprofit that's trying to do this, and we've actually funded a company that's trying to do this. And so I think that's the first thing. I think the second thing that we are figuring out how to do is in our admissions process. There are a lot of people who apply to YC every batch. And one of the things that we're trying to figure out is, can we identify high potential people of any background who don't get in and see if there's something that we can do to help push them over the bar? And I think that this is, once again, something that we can do now because we have this huge base of applicants. That's something that would have been very hard for us to do 10 years ago when we had very few applicants. So these are the two things that I think we can kind of start looking at structurally. But I honestly also think that, one of the things I tell all of the Black founders who've done YC is that you're all trailblazers. Everyone's looking at you to figure out whether or not this is something they should do. And so just like people were looking at me when I was doing it. And so we have an example to set for the next generation.
Okay. So I want to turn to your news of Reddit. So we know that Reddit has faced user backlash, over time and over how it's handled racism involving discussion groups that it hosts. It was announced that you're going to join the board to replace the co-founder. Why join now?
Two things. One, I'm a personal friend of the CEO, Steve Huffman, and I believe that he is going to make Reddit an amazing product for everyone, and I want to help support him do that. So that's the first thing. And then I think the second thing that was very important to me was understanding the obligation that Reddit has as one of the largest social media products. And this is kind of what I talked to Steve about before deciding to do this. I think that a lot of the largest social media products are basically saying, we have this product, people are using it, we're not responsible for the results of its use. And I think the challenge that I put to all of these companies is there becomes a certain point, a certain amount of power and influence where you have to take responsibility for the outcome.
Mhm.
Now, what you're going to do about that, I leave that up to you. But it really pisses me off when people are basically saying, hey, this is just a website. Like, it's not our fault. People do whatever they're going to do, and we're just providing a place for them to do it. That pisses me off. And I think that that's basically just abdicating responsibility. And I think kind of wherever you fall on the spectrum of free speech versus the countering amplification, and kind of wherever you fall on the spectrum of this debate, I think we would all agree that the people who are running the most powerful social media companies have not been loud enough and have not taken enough responsibility for the result of their products. And like, they're shaping the world. So what excites me is I believe Reddit is stepping up. I believe that like announcing the intention to create a policy around hatred is a really important step. And I believe through my conversations with Steve over the years, Steve's core belief is that through Reddit, he can help make the world a better place. And to me, that's something that I want to support.
And just to be clear, on that point, because, there's obviously been issues of, racist communities and in Reddit, including these subreddits, where, the language is just horrible. And, I guess my question is, do you think Reddit should ban subreddits? And more importantly, do you think Reddit should ban hate speech, racism, misogyny?
So if I had my way, I don't think my job in this kind of on the board is to tell Reddit what to do and what not to do. I think my job is to look at the CEO and all of the employees and say, is this the space that you want to create on the internet? And if it's not, what are you going to do to change it? And like, to me, like, that's the most important thing, to basically remind all the people who run Reddit that they have agency and that like what the product of their work, they should be proud of it. And me personally, if I was an employee of Reddit, I would be super pissed if my site had some of the content that Reddit's had in the past, and probably some of the content that it still has. But in my mind, like, that's a question for the people who are running Reddit. And my role is to force them to answer that question. Because I don't think that people who've built bigger social media platforms have taken enough of a leadership position and have kind of forced that question. So I think it's too easy to live under the shadows of larger social media companies and to say, oh, what happens on our site, we're not a part of that. It's clearly not true. Like, you're clearly a part of that. Are you proud of it? Is it what you want to have? If not, then change.
Right. I just have 1.5 more questions on this, and then I want to actually go a little bit broader on, back to the Black professionals point. But before we go there, have you taken a look at executive and employee diversity at the company, and is it enough? And then you mentioned specifically Steve Huffman, and he had a quote that stood out to us, and because he said in 2018, I confusingly said racism is not against the rules, but also isn't welcome on Reddit. This gap between our content policy and our values has eroded our effectiveness in combating hate and racism on Reddit. I accept full responsibility for this. So I know you said that, your friends and you trust them, Just want to be clear. Do you think this is sufficient? And then the question, what does their diversity profile right now look like, and is it enough?
So I don't have, I haven't even gone to the first board meeting yet, so I don't have the full kind of diversity report on the company. What I will tell you is that what Steve communicated around the gap between the Reddit that he wants and the policies that they had in place was one of the biggest reasons why I decided to join. The fact that he was able to look at his product and say there's a gap between where Reddit is now and where I want it to be was a very important factor. So yeah, I'm excited to see what the new policy is going to do, and I'm also excited to see what all of the moderators who really make Reddit special, what they're able to do now that they're going to have more support from kind of Reddit's policies. So yeah, I think it's a great move, and the only thing I could say is like I wish it happened sooner.
Thanks for addressing that. I just want to swivel really quickly back to the Black professionals amongst us who might be seeking some advice on ways, regardless of whatever company they're in, on ways to engage their management chains in order to advance their careers. What would you say is the best way to sort of get that dialogue going?
So I'll start by saying that I'm a startup guy through and through, and so I've only kind of learned about this through my friends who are more corporate. I think that this is once again an example of the world changing and the old advice being exactly wrong.
Mm-hmm.
So the model that I see in the Valley is a model that I call diagonally up. I don't see my talented friends who are working inside of corporate, tech world. I don't see them sticking with one company and working their way up. And like, I think that's kind of like an outdated way of doing things. What I basically see them doing is putting in a 2-year stint at a company and then moving diagonally up, moving to another job at another company with more responsibility. Doing 2 years there, moving diagonally up, moving diagonally up, moving diagonally up. And they're not relying on the company's HR or internal promotion setup or any of that stuff, like employee development. They're not relying on any of that. They're taking it on their own responsibility to jump between companies until they get a role and a set of responsibilities that they're excited by. And to me, that strategy has worked amazingly well for a lot of people that I know in the tech world. And so it's one that I wish more people knew about.
Right. So you're saying the key is to keep mobile effectively, just, go with the flow. What about, I've been in my company for 24 years. What does that say about me?
I don't know. I mean, I don't know about Bloomberg very much, but what I would say is that like, I'm not really trying to say go with the flow, because I think going with the flow is actually maybe sticking at a company. What I'm more trying to say is that instead of plotting your career advancement within one company, plot it within an industry and a set of companies. And think about like, just as much as you might apply for a more advanced role inside of your company, or you might be shooting for a promotion inside of your company, look at other companies as sources of that promotion at the same time.
Right. Understood. Here's a question about 100 of the YC's 2,500 plus investments. About 100 of them drive most of your portfolio's value. What can we learn from the other 1,900? How many died, and what's the takeaway from these failures?
So something that we say to YC founders when they join the program is we can't tell you how to succeed, but we've certainly seen many patterns of failure. And we can help you avoid the traps that have caught many YC companies in the past. The first and biggest one is that, how do I phrase this? not making a product that actually solves the problem that you want to solve. One thing that I see from a lot of startups is that they equate company building with success. And by company building, I mean raising money, hiring employees, speaking at conferences, having all hands, having one-on-ones, doing product meetings. They equate all of the trappings of success with actual success. And so instead of spending a lot of time with their customers and trying to figure out why their current product doesn't actually solve customers' problems, they instead assume that more money and more employees will help make their company better, and they die. By far, that's the number one thing that kills YC companies. The number two thing is tech. Being able to control what you're making and how quickly you can build is one of the superpowers of a startup. And I think the number two thing that gets a startup in trouble is when either they don't have technical founders, or those technical founders are not skilled enough, or even more importantly, they're not fearless enough to be confident in their abilities to learn and grow over time. And I think that something that kind of gets missed in this world is that, like, most of the successful tech startups are doing something hard technically. One of these things I've heard thrown around a lot of days is like, oh, this business doesn't have hard tech. Like, it's just tech enabled. And like, I would argue that, like, you shouldn't think of tech as a barrier. In fact, you should think of tech as like this accelerator. And if you can create software that helps you do something better, it makes you stand out against your competitors. If you can't, that means the barrier to get into your space is lower, and you're going to have more competition, and it's going to be harder. So, like, for some reason, I feel like people like are backing away from tech as opposed to hugging tech. And like, if you're doing a tech startup, you should be hugging software. You should be hugging tech. So that's the second thing. And then I think probably the last one is just, it's really hard. And I think that sometimes people fool themselves into thinking that it's easier than it is. And then unfortunately, once they're in the middle of it, they realize this isn't the life they wanted. And so I think the biggest thing there is, like, understand that, like, whenever you talk to a startup founder, the kind of like first shell protective layer they have is to talk about how well their company's doing. And so you might think, well, I talked to 10 startup founders and 10 of them said things are going great. Maybe the startup thing's really good. Understand that almost every startup is failing. You got to break through that shell to really understand what's really going on. And you've got to be willing to sacrifice to do this. Like, it will require sacrifice. It will require pain. This is not easy. I think some founders haven't quite like they kind of think it's going to be a little bit harder than working at a company. And no, it's a lot harder than working at a company.
Right. So I'm going to go to the floor and take a few questions that are scrolling in, because they're actually they're quite good. So we have one question from Natalia Dorogi, who asked the question: what did you and your team accomplish in the first month of founding Justin TV?
Whew. It's hard for me to answer that in the first month, but let me answer that within the first 3 months. So in the first 3 months of YC, first 3 months of Justin TV, that I was there, we moved to San Francisco, set up the bank account, set up the apartment that we we're going to live and work out of. We got a beta version of the website up and running that could support live video. We got a beta version of chat up and running that could support probably hundreds of simultaneous chatters. And we got a beta version of the camera that we were using to stream live video up and running as well. So within the first 3 months, we could go outside, film live video that would appear on a website that people could watch and that people can chat along with. It took us maybe another month to get that to the point where we felt comfortable launching it publicly. But within 3 months, we had something, probably a little bit sooner than 3 months, we had something that, maybe even 2 months, we had something that we could beta with 10, 15, 20 people.
Mm-hmm. Here's another question. It's something you and I touched on, Michael, a little while ago, from Kai Cash. Asks, the new playbook for innovation and startup success is emerging from beyond Silicon Valley. How do you maintain strong networks as entrepreneurs seek Silicon Valley less and less?
So I think this is one of these situations where you shouldn't believe the Twitter hype. I think that there's this kind of prevailing Twitter narrative that like the Valley is being disrupted and like there are tech hubs everywhere. And like, I actually don't think it serves people to think that way. Whether or not you start your company in the Valley is a very powerful resource for startup founders. And if you're not trying to figure out how to leverage the Valley to help you, whether it's advice, funding, hiring, something, customers, introductions, and your competitors are leveraging the Valley, they'll probably beat you. So what I don't want to say is that every tech company has to be in San Francisco or the Valley. That's clearly not the case. But what I will have to say is that the vast majority of tech companies that are successful have figured out some way to leverage the Valley to make them successful. So doing a startup is really freaking hard. You should use every resource that's available to you. And if you're like too proud to take advantage of the Valley in any way, I think in a weird way, like this startup world is so brutal that like sometimes you got to swallow your pride. Like you need every bit of help you can get. And like if you think about this like some sports team and like, oh, you know, we're the Giants and the Valley's the Cowboys and we hate the Cowboys, like you're not doing it right. Every single founder is on the same team because we're all decided to go after something that's almost impossible to win. And like you're part of a global community of founders and you should be trying to use that community to help you succeed.
Right. The questions are really flowing and fast and furious, but I'll take a few more. So Thomas, who is a mechanical engineer, is wondering if you have any advice on startups with physical products and how that differs from the app space.
I'm glad I got this question because this is another thing that I think people are spreading false information about. Hardware startups are 10 times harder than software startups, period. The number of successful hardware companies that have come out of the Valley over the last 15 years is way smaller than the number of successful software companies. If you're trying to do a hardware startup, one, you must understand this. And two, you must understand that investors know this too. So all too often, I see people just looking at software companies and the ability to raise money and to hire people and do all these cool things, and then trying to just transmute that to any other kind of business. And like, that's not the case. Now, it's not to say that you can't make a very successful hardware startup. There are many. But often, when you peek under the covers, you find things that are not similar to software companies. And I'll give you an example, two examples that I think have really inspired a lot of hardware founders. SpaceX and Tesla. Elon Musk was already very wealthy when these companies started. Very, very wealthy. And so that's the first thing. The second thing is that both SpaceX and Tesla got a ton of money from the government, which is not typical for a software startup. SpaceX got a NASA contract, and Tesla got a $500 million loan from the Department of Energy. And so often when you kind of peel back the kind of the details, when you get to the details of some of these successful hardware companies, you start realizing how different they are from the successful software companies, and therefore how much harder. And so the only thing I would tell a hardware founder is go in with both eyes open. If you're passionate about it, do it, but go in with both eyes open because it is much harder. And I'll just kind of put a final note on this because I think this comes up a lot. We had a company, DYC, creating consumer hardware products. They sold $250 million worth of that product over the life of the company. And because they slightly misestimated their Christmas sales numbers, that mistake created a cascading failure that caused them to go out of business. After selling $250 million worth of product, that's the definition of hard. At Justin TV, we made mistakes like that all the time. If we were running that company, we would have died years earlier. It's harder.
Right. Here's an interesting question about education from Asif Khan. He says, "Hi, Michael. I wanted to ask about your thoughts on the future of education. How do you think ed tech will fare once students can return to school? And do you think we will shift towards a more affordable, personalized, adaptable, and digital model of learning in the next 10 to 15 years?"
The answer to that question for me is I don't know. I think that education startups in general have kind of suffered a really tricky setup where they kind of straddle this line between nonprofits and for-profits. No one does an ed tech company because they want to sell products exclusively to the rich. But on the flip side, the process of selling or giving away software for free to a large group of people has a lot of cost. And it's hard to make those businesses work. I'm interested, and I think that there's potential for ed tech startups that charge their users and that give their users, rich or poor, so much of an advantage and do it with software that's so relatively inexpensive that it makes sense even for a poor person to pay. And I wish more founders in the ed tech world were focused on charging their end users versus selling into K-12 or colleges, which is so hard, or doing nonprofits and trying to raise money from foundations, which is so hard. I think there's this myth that poor people don't have money. And it's just a myth. Like, poor people have less money and they have to be much more careful about how they spend it. But if you can offer a poor person an opportunity at a reasonable price to significantly improve themselves, they'll take it. And like, software enables that in a way that physical businesses don't. And so I think that there's a lot of potential with edtech if edtech founders got a little bit more software focused and a little bit braver to charge their end users. I think there's a lot of interesting stuff that can be done there.
So we have roughly 5 minutes, and I promised a little treat at the end. So I'm going to do one more question and then a half-turn question. This one, Mr. Seibel, you mentioned high potential founders, applicants, and identifying them. In your opinion, how would you go about identifying such applicants? What metrics or signals do you think give good insight?
I mean, I'll tell you a top one just off right at the top of my head. Ability to write code. I think in a technology startup, like, more often than not, that's one of the most important skills. And so, yeah, I mean, off the top of my head, that one probably outshines anything else. Ability to write code. If you can create software, you can come up with ideas that can solve any number of problems. If you can't create software, you can come up with the ideas, but you can't actually build the products. So creating software is a superpower in our world. And one of my thought processes is that a big way this world would get diversified is by Black technical people deciding that they should be starting companies as opposed to working for companies. Because I believe Black technical people will hire a far more diverse employee base than a standard founder would.
So I'm going to double barrel these two because I think they're important questions. And one I should have followed up with you on at the outset, which was we talked about what the first month, first 3 months, but how did you actually go about starting your business just from the outset? You talk about ideas, just start or just do it without going into the process. So that's part one. And then part two, someone wants to know, are you still accepting applications for YC?
Yes, so I can answer both of those really quickly. First, I didn't come up with the idea for Justin TV, so I was not involved in the idea stage. The general advice that I would give founders when coming up with ideas is one, don't follow the hype train. If something's being hyped right now, just ignore it. And two, start with a personal problem, a problem where when you use your product, you can tell whether it's working well or not. One of the most common kind of cold emails I get from founders is, how do I find the first customers for my product? That's not a question that you would ask if you were solving your own problem, because one, you'd be the first customer of your product. And two, you tend to know other people who have similar problems that you do. Second, YC accepts applications throughout the year. If you look at the website and you read it, it literally says you can apply late at any time. And like a perfect example, Airbnb was a late application to YC. So while YC has created this process, it's a flexible process. If you let someone convince you that what's on the website isn't true, then like you're kind of harming yourself. Like on the website, the apply button's always there. You can always fill out an application. You can always submit an application.
Got it. Okay, so
It's
now
not
we're going
like
to do it. Sorry?
I said it's not like college.
It's not like college. Got it. All noted. We'll all be applying tomorrow. Add to the 12,000 applications you get every 6 months. Okay, so I'm going to close with a little bit of a lightning round. And in this sort of fast phase of our finale, I'm going to ask Michael to, in a few sound bites, speak to 4 questions. 1, what is something YC doesn't do today that it should do to be more helpful to its companies?
I think the next generation of YC is going to be even better at helping our companies get customers. There are now 5,000 alumni at YC, and these alumni both have active companies. And if they don't have active companies, they're out working at some of the best companies in the world. And one thing that YC can do better is basically making it easier for our active companies to sell to our alumni. And that's something we're investing a lot of time and energy into.
Got it. Do you have a role model? And if so, who is that?
I don't.
No role models. Okay. The Pope? No. Obama? Okay. What keeps you awake?
You're wrong.
Yeah?
He doesn't do
Go on.
I said I love Obama, but he doesn't do tax. So, like, I can't
Right,
learn from his
okay.
life.
No tech role models. Okay, got you. All right, what keeps you awake at night?
Probably the biggest thing that keeps me awake at night actually is learning how to optimize myself and my time and take better control over my time. I feel like I have a really impactful job, and so it's like my responsibility to be as efficient with my time as humanly possible. And so I've, as of late, as of the last year or so, I've really been trying to spend a lot of time figuring out how to make sure I'm wasting as little bit of time as possible and getting the most done as possible every day.
East Coast versus West Coast. If we're talking about tech founders, name one strength of the West and one of the East.
So this is tricky. And we have this debate all the time with a lot of YC founders informally. I would say that, like, all things being equal, living on the East Coast is better. It's more culture, more diversity, more access to people, more access to other cities than in San Francisco. I think with San Francisco, the only advantage is it's a city built for tech founders. And so, like, it doesn't have the culture, it doesn't have the diversity, it doesn't have the nearness to other cities. But what it does have is, like, it's very fertile ground for tech startups. And so what it does have is a bunch of investors, a bunch of people who can give you advice, a bunch of other founders who've gone through the same thing. And so it's kind of like, it's this mixed bag. It's kind of like more uncomfortable life, but probably more fertile place to do startup work.
Got it. I was going to ask you about your favorite social media platform, but I think I know the answer to that. So I think on that note, I'm going to say, Michael, thank you so much for your thoughtfulness and your time. I think we all have great takeaways from the discussion. I wish you the best. Have a great day.
Thank you so much. It was great chatting with you all.